right, joining us right now to talk markets ahead of the Fed's favored PCE inflation numbers that we get in just over an hour's time is Jeremy Siegel. He is Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business. He's also the chief economist at Wisdom Tree. And Jeremy, what are you anticipating? What are you expecting from this number today?
I actually expect that the year over year is going to be a little hotter than expectations. And I'll tell you, because we already got the first quarter PCE consumption. So if you kind of work backwards from the data we got yesterday, they did revise it upward. It will be a little bit hotter. However, forward looking, I think inflation looks very, very good. The month over month numbers might be on target. We might be 1/10 higher on the other. So I don't think it changes the narrative at all that, Jay Powell's going to tee up a rate cut for the September meeting after this next one.
Yeah, next week when the Fed meets again, even if it's hotter, you don't think that will make his rhetoric or what he says any more hawkish?
No, I don't. I actually don't think so because, again, forward-looking numbers, I mean, we really take a look at commodity prices, even oil prices have come down. Those are very sensitive prices. So what home prices, rental prices, we're beginning to get the rental price index, which we know is lagged in the official data. We're getting to see that really come in at a much lower rate. So, and that's all great news. So I think that won't change the narrative. Now, he's not going to promise anything. Of course, he said if trends continue on the direction that we see, we would be amenable to easing financial conditions at our next meeting. And certainly he's not even going to commit how much it's going to be. But I think that's definitely what's going to be the setup next week.
And you think the Fed should be cutting right now?
I mean, if it were up to me, looking forward, they should be. I mean, I think ultimately the Fed funds rate should be 3.5 to 4. Now, I'm not saying get there tomorrow or get there by the end of the year, but we're 5.33 now. So we're about 200 basis points, almost 200 basis points above that neutral rate, which actually the Fed actually thinks the neutral rate is even lower than that. I think it's a bit higher. But I think we should really be moving towards that direction when we look at the trends in the economy. I mean, GDP is holding up, but at a moderate rate. So the labor market is no longer a tightness that they have to be concerned about. And basically it's forward inflation. And that looks very, very good to me coming from the data that I research.
Let's take a look at what we've seen in the markets. There have been some big rotations over the last several weeks and even last several months. One of them is this move towards small caps away from the big caps. The other is this move towards value over growth.
Yeah. And actually, both of them are tied together quite strongly. I mean, we had up until about 2.5 weeks ago, we had a month period of one of the strongest growth pushes relative to value that I've ever seen. And then in just 2 weeks, pop, it's gone. It's sort of easy come, easy go. But if you take a look at the long-term trends, actually, growth versus value is back to that trend before we had that pop bubble. But, as I said many weeks ago, you're not going to get value moving until the Fed drops rates. And more when you see that, rate drops are in the cards for the Fed, I think that narrative could very well continue. Now, I think there might be a little bit of a bounce back for tech because it certainly has taken a big pounding recently. But you do see a narrative change. You even see a narrative change about is AI as big as we thought it was? Right. I mean, that feeds into the other situation. So, this really could be a watershed in terms of a trend that we've seen for many, many months, if not many years, of growth beating value.